Assalamu Alaikum everyone, welcome back to another video. In this one we are looking at two very similar companies, and that is Visa and Mastercard. But before I start looking at the financials, I want to just quickly mention about Sharia compliance side of things. These two companies do not actually deal with anything to do with debt or interest payment or any of these things. They are just simply technology companies that provide the network that actually are used in those cards. The bank issues the card, but they do the technology behind it. They don't really care how much money you get or how much money the bank makes off you when you buying stuff with your credit card and so on. They don't collect any of the debt, so they don't deal with the interest payment, none of those things. So it's very important to remember that, because I have had conversations with a few people and in the groups and obviously face to face that said, actually, are these companies Sharia compliant? And absolutely yes. And if you look at Zoya, there's nothing wrong with these two companies. But before we start looking at that, I just want to mention a couple of things about generally the market and what's going on. So right now the market is open today, and as you can see, it looks a lot green. Pfizer is absolutely going crazy because of something to do with COVID situation that happened, their new drug they're coming up with. Because of that, a lot of the other companies are actually under pressure. Merck, who's been up quite a lot lately, is actually now down today. But the other company that I want to mention is that I actually reported their earnings a couple of days ago that I own in my portfolio is Qualcomm. It's done absolutely brilliant, and just on that day, on that news, it went up almost, I think, 11 or 12%. This is a company I've been in my portfolio for a very long time. I'll share the videos that I'll put the link in the description, but you can just have a look at the video that I've done on this company. Great company. It's actually now everybody else has been talking about the shortage and basically lack of in terms of the commodities, in terms of things that they need basically to be able to create the chips, in terms of supply chain problems and so on. They didn't say anything. They actually have a group, basically in terms of their report, they reported a great quarter, and obviously the forecast is also great as well. So this is one of the best companies that I actually own in my portfolio in terms of 5G. I'm going to hold on to it. I will share. I'm doing a video tomorrow for portfolio update. So if you want to obviously check out that one tomorrow, inshallah, just subscribe, like, and let me know if you have any questions, and I'm going to do that video and share with everybody tomorrow, inshallah. So that is one of the companies that I own that's been doing really well. The other thing I just want to talk about today is Peloton. Now this is just crazy because this stock not long ago, I think about a year ago, it was over 100 something. There you go. So $165 per share, and right now it is just today lost about almost 30%. Okay, no, 33% down today. And that's absolutely crazy because the earnings report apparently was terrible, the forecast was terrible, and whatever it is. This is what scares me about the stock market and about these hype companies. Now this company, apparently they have a good product, but because of COVID, everybody stopped buying their products, their shares, whatever, the company just went up crazy. Okay, and because the valuations and the company, what the company is doing are not basically do not much. This is the kind of thing that happens. So please just be careful when you're buying these crazy companies that just have no valuations and so on. Stick with the companies that have a free, basically, free cash flow. They've been around for a while. If you want to take a risk, obviously take a calculated risk and always look into the financials instead of just following the hype, because when you follow the hype, this is the kind of thing that can happen. The other one I think I looked at recently was Teladoc. I think, again, great business model. Teladoc is great in terms of their business model, but the stock just went too high as well. So that's another company that I've seen recently that went down really a lot. So this is the type of stock that I just want to stay away from. If you are happy, if you know the company is going to be around a long time and they have a good financials, whatever, just look for a drop like this today. So if you believe this company has got the potential to grow into, like, I don't know, 100 billion or 200 billion dollar company in terms of market cap, and basically they have the potential, maybe today is a good time to buy. Okay, but I don't really know much about this company. I don't even know if they're Sharia compliant, but I just wanted to share this with you guys to kind of obviously explain the fact that sometimes this sort of a thing do happen, and I don't want anyone in the group, in our team, to actually lose money. So just please be careful. Right, the first company that we're going to look at is Visa. Visa is, I think, it's got a market cap of over $470 billion. In terms of beta, you can see is less than 1%, which is absolutely fine. PE is quite high at the moment, so 38. Earnings per share of 563, and then they do pay some small, very small dividend, so just like $1.50 per share that you own. In terms of financials, you can see, so this is annualized, so that you can see the total revenue from the last 5 years. So 20.6 billion, almost $23 billion, $22 billion, 24, and then 24. Even when COVID hit hard, they are still actually just got done a little bit, but not a lot, to be honest. And then this is the thing about these companies. Look at this. So operating revenue. So let me just actually close that bit. So in terms of, this is the revenue they made. This is how much it cost them basically to make that. So the cost of making $24 billion is only about $5 billion. And the gross profit from that is $19 billion. That is some ridiculous margins, really crazy. And then when you look at their net income, this is what they take after they pay all these taxes and other things, expenses that they need to pay, is about $12 billion. Really good. So the revenue is growing, they have a great gross profit, they have an amazing net income. Let's now look at their debt and see if there's any problems with that. So their total assets right now is about $82 billion, or almost $83 billion, but their current assets, you can see now, is $27.6 billion. Okay, when we look at their total current liabilities, so this is the basically things that they need to pay in the next 12 months. They have enough money to pay that off and still have a lot of money left over to almost $10 billion. Now, the other thing we normally look for is share issuing, for example, and this is heading the right direction, and that is going down because the company is buying back their own shares, which is really good for us, because that means every share you own now is actually worth more. When they issue more, especially newer companies, they will always issue more shares, which means basically they're diluting your own shares to the point where basically it's not worth what you paid for initially. And then cash flow here, we're looking at about $14.5 billion in cash. Now, this is very important because this is the money they use to pay off dividend. This is the money they pay off, use to pay off, and or basically come up with the new technologies, reinvest in the company, and obviously make us happy by just paying us extra little bit of dividend. Now, they recently increased their dividend, okay, because they got a lot of money. I think they increased it last one about 17% increase, which is massive. To be honest with you, that they have a lot of money, and obviously the dividends are not a lot. It's not a lot, so therefore they can afford to do that. The final thing we're going to look at on Yahoo Finance, a couple of more things. So in terms of growth estimate, the analysts are expecting about 19% this year, next year about the same, and then next 5 years basically they're expecting almost 18% growth. Really good. Again, it's a strong buy at the moment, an average price of $275 per share. So according to this website, that's what they're doing. One other thing I like about this company is the fact that they're into the crypto side of things. So they are basically, they've got cards that they can basically, this is their plan. So they recently, and the CEO said, we are doing a lot to create a basically ecosystem that makes cryptocurrency more usable and more like any other currency. So maybe their plan is to create a card where you can actually if you have a cryptocurrency, you can use that in shops and things like that. And if they do that, I think that will be a game changer. So we'll see what happens with that one. Then you've got two in terms of tip rank. They're currently saying it's a strong buy, so 12 buys, 1 hold, no sales whatsoever, and £274 per share, and it's currently trading $216. I think it's up quite a bit today. Let me go back here. Yeah, it's up almost to 3.5% today. So that is Visa. And final thing I want to show you about Visa is the Morningstar. Again, they have a fair value of $217 per share, and that is about where it is right now. So it's still a fair valued, a company that has a return on basically equity of 33%, net margin of almost a 50% or 48%, and return on assets of 13%, and so on. So really look at that pro and operating margins of 64% as well. Great company. I absolutely love this company. I own only 5 shares, but I'm planning to buy more hopefully soon. Right, and the final thing for Visa is the fact that according to Simply Safe Dividend, their dividends is very safe. Like I said before, 0.7% of dividend, and they are growing it very fast. So just this year they've actually grown, like I was saying earlier, about 17%, which is absolutely brilliant to see. Right, the next company that we're looking at is Mastercard. Again, like I said, I'm comparing the two to see which one is. Obviously Visa is a lot bigger, so this one is about $336 billion. Again, quite similar volatility wise. PE ratio is slightly higher, and then EPS is actually higher. They get paid, earnings per share is actually higher here, and then you've got similar sort of a when it comes to dividend, you get about 0.52 or 0.52%, which works out $1.76 per pence per share. Right, the other thing we're going to look at is financials to see it's actually how good or bad it is in comparison to Visa. So you're looking about from 2017, $12.5 billion, again almost $15 billion. So it's heading the right directions. It went down 2020, but it looks like it's bouncing back in 2021. And then the cost again is very low, and gross profit is very similar too. So these two companies are very similar in terms of their gross profits and revenues and how much of that they actually keep. And then we've got net income of $8 billion, which is great. When we look at their balance sheet, so we now need to look at their debt, current assets against their current liabilities. As you can see here, their current assets is basically $19 billion in comparison to 11.8, almost $12 billion. So they've got enough to pay that off. And then when shares issued, again, it looks like they've actually issued more shares recently, probably because of 2020. I don't know why they've done that, but they've done it. Actually, they've increased it just once, because this is almost the last 12 months, right? So that's that one there. And then you've got cash flow here. So when we look at it again, $7.8 billion. So really good. So they financially, they are stable. They're doing really well. The only negative so far is issuing more shares, but it doesn't look like it's actually a lot. So that is something to look for, maybe just to think about. Right. So the final thing we're going to talk about is in this website is the current year in terms of growth wise. So it looks like Mastercard is basically projected to grow more than Visa, but obviously not by much. So 28%, again 27.6%, and then you've got next 5 years 26%. Really good. I mean, this is perfect. This is what you're paying for. So the fact that the PE ratio is quite high now, this is the reason. Okay, because people see this, they see the growth, and they're like, okay, I'm willing to bet on this and pay a little bit more than what I usually would have paid, and that's absolutely fine. Okay, to me that's absolutely fine. Okay, I don't know about you, but to me that's absolutely fine. This looks like it's a buy here as well, and then $431 per share, and right now is $345 per share. And when we look at tip rank, so tip rank is again similar. So they've got 9 buys, so strong buy, 9 buys, 1 hold, 0 sell, and $433 per share projected. So that's the average they're looking at the moment. And then when we look at Morningstar, and their fair value is $337 per share. And when you look at it right now, it's 346. So slightly higher than, obviously, because it went up quite crazy today. Probably that is the reason why it's gone up. Again, very similar in terms of their profit margins, in terms of net margins, in terms of return on equity, return on assets, and things like that. So really not a lot to separate the two companies. Again, similar thing. They're planning to obviously get into the crypto world. And again, because they have, I think they've got a deal with what is it called, Coinbase, to use their cards and so on. So I'm not really too sure what's going on with that one. But again, it looks like they also, both the companies are planning to get to the crypto world, which is absolutely understandable. I mean, I want both of them to actually get to that, because obviously the more their cards are used in this kind of environment, the better, the more customers they have, the better for the company, obviously. And it looks like it's very similar to Visa, so 99, which is the highest you can give it to any company, and they've grown at 10% in comparison to Visa. Visa was growing about 17%, but in here they've only grown at about 10%. So really, really good. Both companies have a great future ahead of them. They are in the right industry. Almost every single one of us right now watching these videos, I mean, have a Visa card or Mastercard. Okay, and that says a lot. In the developed world, almost everyone carries those cards. So why not put your bet on some of these companies instead of looking things like, you know, companies like Peloton or whatever, companies that really haven't established themselves yet? I'd rather put my bet on this than any other in some of these companies. When you look at my overall portfolio here, I have 5 shares of Visa, just to be transparent. It's just down a little bit. Okay, it was down quite a bit recently. I should have bought more. I didn't. I think it was about a week ago. There you go. So it was down quite a bit. I haven't purchased more. I should have, but hey, that's absolutely fine. And then I also bought Mastercard. So Mastercard is actually new edition. I've only started buying it this week. I've got a video coming up tomorrow about the portfolio. I've done quite a bit of updates, so I'm gonna let you guys know exactly what I've been doing. Remember, the only reason I created this channel is to show you my journey and the reasons why I invest in certain companies and why I don't invest in certain companies and so on. One of the things I've done is actually I bought start buying Mastercard. I've been waiting for it to go down for a while, but it's been hovering around 340, 350. So if you look at basically just this month, it was trading almost $370 per share, but it went as down, so 328. So I stopped buying when it was about 334. That's my average at the moment, but it looks like it kind of paid off because it's up a little bit and about 4% so far. So I am happy with it. I'm happy that I bought, and I'm going to keep buying it while still is fair value, because this company actually shoots up. It is very volatile, I'll tell you that much. Visa could be, and basically Mastercard could be up 20%, and the next 3-4 days could be down another 5 or 10%, whatever, just like that. So yeah, just be careful with these companies. Obviously, if you're interested, obviously look into the details, financial details, dig a bit more, find out exactly how they operate, how they actually generate profits and so on. Remember, when we look at these kind of things, I'm just looking at it from financial perspective. You then need to go into their earnings report and see where exactly the money comes from. Is it from the services side of things? Is it the software? What is it that they actually sell? And that is really important, and that's something that you need to look at when you're thinking about this type of companies. Right, I'm going to release another video tomorrow, inshallah. So if you like this type of content and you're enjoying and you feel like you're getting something out of this, please like the videos, because the more likes it gets, the more people are talking about it. Obviously, the more people can see it, and inshallah, my purpose is just to share my journey and obviously help other brothers and sisters out there who are in a very similar situation as us. Assalamu Alaikum, everybody. Take care.